wage inflation is the one we're all watching, because in the debate about whether inflation is likely to be transitory or longer lasting, I think wages really are key. I mean, historically, that's been one of the almost early indicator of inflation that has worried central banks more than any other factor. I mean, if you look at inflation today, I mean, there's the statistical effects. Those are, of course, could push inflation a bit higher, but those are temporary, looking out beyond the next couple of months. A lot of the supply issues, again, historically have tended to be, fairly transitory as well. But the thing with wages is that, wages tend to grow on a sustainable basis once labor markets are tight. But when you look at major economies, whether it's Australia, whether it's the US, we're quite some distance away from low unemployment levels or the high levels of absolute employment that have characterized, tight labor market. And that really feeds through our view that, look, we're absolutely not putting all our eggs in a purely transitory inflation basket alone. But, it's tough to make a case for sustained long-lasting inflation when there's such a big gap between full employment and where we are today. So that's the reason why we still think we still have some way to go, though, and that sort of drives partly a view on equities, which, of course, benefit from, transitory inflation where, bond yields and inflation sort of remain fairly contained. But to be honest, equities also do end up performing quite well if we do get inflation that lasts longer than we expect, but obviously is contained within about 3% in the US, for example.
But 3% in the US would be a lot, Manpreet. PCE, core deflator, if that's what you're talking about. I don't think analysts reading reports from Goldman Sachs, Morgan Stanley, I think they're circling around between 2.2, 2.3%. I mean, the last read of 3.1% was really seen as an aberration. If that sustains, that would really move the needle and worry the Fed, no?
You're right. That scenario would, and that's absolutely not our base scenario. I mean, we're looking for, obviously, a rise in. We're focusing initially more on CPI, but you can transfer those one-to-one to a lower PCE number, running till about mid-year and then potentially coming off as the base effects exit the calculation from about into the second half. But I think as an investor, what we're trying to say is, look, there are a number of scenarios out there. Our baseline scenario is that that rise in inflation is transitory, and we go back to a sub 2% CPI number going into next year. But we're also as an investor, we're faced with the choice of, look, you put all your eggs in that basket alone, or is there a risk that some of the stimulus dries up wages a little bit more than we expect, or if some of the supply chain sort of hindrances last a little longer than we expect? And I think that's when we looked across different asset classes through history. Of course, equities do quite well, and as do many sort of risky bonds in a scenario where inflation is quite transitory and we sort of have lower inflation numbers. But let's say for a moment that the inflation is a little bit higher, a little bit longer lasting than we expect. Actually, equities still end up being a pretty good bet. My point about 3% is that actually up to about that level, equities are still ended up being one of the top performing asset classes as long as economic growth is held up. That really is the key, more than inflation, to asset class performance. And that's what's driving, I think, a preference for equities and to an extent a preference for balancing that with a preference for gold.